Yup. We're back. Happy September.
Best time of the year?
You ready for this? Did you take pictures of the kids going to school today?
Best time of the year? Of course I did.
You think this is the best time of the year? Is this your favorite?
For me, it's my favorite. It's my number one.
Okay. I'm like a July guy, but I don't mind this.
You know what I've been doing?
It's still hot out. It's still sunny.
Been doing this on the call. I've got a Rubik's Cube in my hand.
Don't multitask me with that thing. I'll come to your house and throw it out.
Just on Zooms. And guess what? I don't even know what I'm doing. Can't even do it. It's just therapeutic. I just like doing this.
For the listening audience, Michael's playing with a Rubik's Cube. Okay.
I said a Rubik's Cube. I know about the listeners. I take it from here. Shush. We've got a sponsor. Very special sponsor. So listen to this. I've been talking about Rocket Money for a while now. Rocket Money tells you like what your upcoming payments are. So if you want to find out like what do I even subscribe to? This way you don't have to download on Chase and sort by vendor, whatever.
This is your recurring subscription payments.
And it does a lot more than that. But listen to this. I found out that I was paying for another company that allegedly does the same thing. Doesn't even work. I didn't even know that I was paying for it. And I can't even log on to it.
Wait, you were paying for a competitor of Rocket Money?
Yes.
And Rocket Money turned that up?
And believe you me, a much less lousy competitor that I couldn't even log on, couldn't reset my password. I had to go through my whole rigmarole to get a canceled and refund. And anyway, Rocket Money's it's fantastic.
Do we have a code? What are we doing? Rocketmoney.com/compound?
Rocketmoney.com/ try that. No, I'm just kidding.
Check it out and use our code.
I love it.
And yeah, I think it's a great idea. I should do it. I should let me correct myself. I should have Sprinkles do it. All right, I want to say a couple of quick hellos here. Rob and Nicole are in the chat. Everybody say hi. Jack Rosenfield is here. Pam Hill, good to see you. Mike Waller. Saad Malik is here. MD, Drew Hickman. Roger's here. Sean's here. All the regulars are here tonight. We appreciate you guys spending your time with us. I think tonight's show is going to be great because we did not do the Compound and Friends at the end of last week. I just have a lot of things built up that I wanted to get out. And I think the doc reflects that, but it's not overly stacked. The main thing I want to say, I think August's correction, it wasn't really a correction. The August dip, mostly in tech stocks.
Garden variety correction.
Perfectly fine. I think we're going higher. Like, I feel better about us going higher after that sell-off than I did in July even. Because I watched, this is how I operate, Michael.
Yeah, July was dumb.
I watched the internals like a hawk during that sell-off. You could say I was stalking them because what I'm really looking for, how did the weak stocks weather it? How did the strong stocks weather it? And I was like looking into different names in each sector and really trying to understand. And everything that I saw looked textbook correcting an overbought market.
We're going lower.
You think so? Well, today wasn't great, right?
Today was not good.
Let's do Ari Wald. Ari is one of our favorite technicians at Oppenheimer. Ari agrees with me. He put this out over the weekend.
Hang on. You agree with Ari. You're using his work, sir. Well, don't get it twisted.
Not solely, but sure. I'm using his work right now. I agree with Ari. The S&P 500 reclaimed its 50-day average last week following a 2-week stint below the short-term trend. The key takeaway in our work is that whether or not the advance is resuming imminently, it should only be a matter of time. The Russell 2000's ability to uphold its 200-day average, combined with risk-on leadership and bullish intermarket checks, those are those checks I told you I was doing, reinforces our view that a seasonal correction should prove temporary and an opportunity to buy into a middle innings bull cycle. Corrective periods often develop in 3 waves, down, up, down, meaning a final, less intense setback against late September headwinds would be reasonable. Put this chart up. So Ari's saying we view our conviction to buy leadership versus sell laggards as a net positive for the overall market too. Still recommend buying weakness rather than selling strength. And he thinks 45.65 resistance, 44.70 support. What we're showing you here is the S&P 500 and the Russell 2000 as a proxy for internal breadth, meaning it's 2,000 companies. They're smaller than the S&P. And so long as they are cooperating with the rally and bouncing off important support levels as they just did, that's a bullish signal in Ari's in Ari's favor. Chart off, Michael. What are your thoughts?
You and I were talking with Dan Nathan and Guy Adami a couple of weeks ago that there was a lot of signs of short-term excess and that an orderly correction was in order. We got it. The question is, of course, where do we go from here?
Did we like almost nail the top with that? They were like, so you guys are always bullish? And we're like, no, actually, not really. Things seem a little crazy, right? I think it was late July.
A lot of things, we're not geniuses. A lot of things lined up.
No, I agree.
A lot of things happened to line up. So here we are. On the other side of that, I think, I've got some data, not to jump too far ahead, showing what happens after a very strong start of the year and a down August. And it's exactly, it's up, down, up.
So let me do my seasonal thing, and then I want to get to that.
Okay.
Ari notes that seasonals become a tailwind in Q4. So if you're around the market long enough, you'll hear the old timers referencing the Stock Traders Almanac and talking about seasonals. And Michael doesn't like this stuff, and I mostly don't like it, but I sort of understand that there is a basis in reality, but it doesn't really help you. Like if somebody's like, 75% of the time October is up, okay, great. What tells me when we're in the 25%? I don't know. So that's why like seasonals are like sort of bullshitty, but there is a basis in reality for why there is some like rhyme and reason. Anyway, Ari points out the S&P 500 continues to track its seasonal tendency too. Looking at the last 10 pre-election years chart on, an average composite of the S&P temporarily peaks in July, bottoms in late August, stabilizes through September, resumes higher in October. Based on this analog, the S&P typically rallies through the initial weeks of September. This is 10 years worth, so it's every 4 years since 1983. In the presidential cycle, this is the pre-election year, and what we're showing you is a composite of the S&P 500, and what you can clearly see here is August sucks, okay, check. September, get a little bit of a rally at the beginning of the month, get a little sell-off toward the end, and then bottom before October, off to the races, new highs by year end. I'm not saying that's going to happen. I'm saying historically that has happened enough to produce that pattern that we're showing you on the screen. So from that standpoint, I like the setup. And I do think that there is something. It's not astrology. It's what I really want to say.
Yeah, I agree. I don't think it's all bullshit. I don't like. I mean, there's a lot of seasonality that I will dismiss out of hand. This is not one of them. I think
you don't like stuff where it's like buy Rosh Hashanah, sell Yom Kippur,
of course,
or
and if it doesn't,
Santa Claus. Like I get it.
Right,
I don't like that shit either.
Right. All right. So this is from Nautilus Investment Research. The S&P 500, when it's up 15 to 20% through the end of August, the rest of the year, and you probably can't see that, so I'll tell you the data. It's been higher. How many times is this? I don't know, 15 or so. It's been higher all but one time, and that was 1986, meaning the rest of the year. So the rest of the year was negative once out of 15 or so periods when the market was up 15 to 20% through the end of August. So information like this, I think is a little bit more than interesting.
I'm sorry. Can you just like not re-explain it because I understand it, but
you tend to do this a lot. Chart off. Look at me for a second. When I explain something, you tell me to re-explain it for the audience. I just explained it. It's very simple. You're a smart man. It's very simple. When the S&P 500, when the S&P 500 is up between 15 and 20% through the end of August.
Okay.
So from September through the rest of the year, it has only been down one time. Not for the full year, just September through the end of the year.
That's great, but what I want to ask you is how much was the S&P 500 up through August?
15.4%.
So we fall within that threshold.
Yeah.
Just barely though.
You're not going to bet the farm or mortgage your house, but historically this has been really bullish.
Why do you think that happens?
Just momentum. People tend to chase, and stocks aren't going up for no reason. Within every one of these years, you could look back and say, you could offer a number of reasons why the stock market was up this year or that year. I would say
do any of these years in the table correspond to a prior year that was horrible, such as the one that we just went through? Because throw that chart back on.
I feel like 1966 was not a good year, but I don't know. I don't know off the top of my head.
Yeah, I don't either.
I mean, a good rule of thumb is this: just if you're just going back to the very basics, there's a great book called "It Was a Very Good Year." Shut off, please. And what history shows is that very good years tend to follow very bad years. Why? Because investors do a very good job at over discounting what could go wrong. And even if stuff does go wrong, it doesn't go all the way wrong as people bake into the market.
So I think this is interesting because I think there's a lot of career risk in missing a year like this year, and all years like this, quite frankly. When the S&P is up 15% and the NASDAQ is up 40%, and by the way, in most of those years you just showed me, the NASDAQ didn't even exist, and it was never as important as it is right now. So right now you have this setup where, for argument's sake, let's say the NASDAQ is almost as important as the S&P.
You know how much
for a lot
NASDAQ
of
is up, by
asset
the way?
managers.
NASDAQ's up 42%. Continue.
Yeah. So this is my point. So you don't just have career risk based on the S&P anymore. If you're a growth manager, you have career risk against the NASDAQ. So now you have a setup where we're in September, and if you're trailing this shit by 10 percentage points, you might not be working next year.
Right.
What do you have to lose? Buy
Chase. Yeah, Chase.
Buy semiconductor stocks or get your resume ready. So that's what when people are like, well, what's the fundamental reason for
Doesn't
why?
matter. Fundamentals.
To me, it does. What's the fundamental, what's the scientific explanation behind why there's only once been a down finish to a year that went through August of 15% plus? This is the reason why. It's the agency problem. It's a principal agent problem. The people that are managing the money have the most to lose by not chasing for themselves. There's a selfishness here.
This is why this type of I know this is not seasonality. This is the type of data that I like because you said what's the science behind it? Human behavior is the science behind it.
Yeah.
And the patterns that are created by this human behavior tends to persist.
Right.
Because that doesn't change. We're all human. And at some point, you got to chase. Right? So, okay.
Yes.
What else do we have in here? This is a great chart.
Do it.
A borderline chef's kiss chart. So this is from Grant Hawkridge, and he tweets, my risk on risk off ratio is breaking out to fresh all-time highs. So on top, the risk on index is a composite of copper, high yield bonds, the Aussie dollar, semiconductors, and high beta stocks.
And cocaine.
That's the green line, and yeah, tons of that. The red line is gold, U.S. Treasury bonds, yen, utilities, and staples. That's risk off. Now, if you take the spread between the risk on and the risk off, that is breaking out to new highs. So listen, today was a rough day in the market. It was mostly mega cap, with I think it was like 390 names down in the S&P, 110 up, something like that. But whatever, that's one day. But generally speaking, risk on assets, especially relative to risk off assets, are breaking out to fresh highs.
Right.
So hard to fight this. And then when you consider the fact that we just discussed that people are underinvested and most managers are not beating their benchmarks, certainly not the NASDAQ, barring something happening over the next, a couple of weeks that derails the rally, they're going to chase.
Can this thing put this chart back up though? Can these things can reverse really quickly? Risk on index, risk off index. Yeah. Right now, it appears really clear where the money is going and what it's being bet on. And utilities are trash.
I own them. Trash.
And semis and copper are on fire. Okay, but I feel like that's the kind of thing where don't get too confident as a result of this because it could stop on a dime and reverse.
Totally.
And a lot of things can, but I've seen it. So
But if we look at who are we talking with who was throwing up all those equal weight charts, it might have been JC. If you look like equal weight discretionary versus staples, all of the signs that you want to see, just literally strip out everything that you see in the headlines. If you just look inside the market, and the market is much better at forecasting the next 6 to 12 months than anybody is, if you look just at how the market's behaving, it's risk on. And it can change at any moment.
Yeah, I agree. And, it's frustrating because that's the thing you don't know. Are you closer to the beginning or the end of the trend? Nobody really knows. So a lot of people have these secondary and tertiary confirmations that they seek, and some work, some don't. Sometimes the ones that worked last year don't work this year, and that's why it's a ball game. I want to move there was an op-ed at the Wall Street Journal that just was a scathing take on what regulators, mostly FTC and SEC want to do to the private markets. Basically, there's been like this, and I don't really have that strong of an opinion other than to say, be careful what you wish for. Over the last couple of years, there's been a lot of stuff in wealth management and in asset management where, we're going to democratize this and we're going to make such and such asset class available to mom and pop, and we're going to level the playing field. And be careful what you wish for, because when you open the door to retail and there's a buzz, this is the inevitable result. The regulators are going to be like, wait, how much money is going into this stuff? And they take a second look, and they're going to see some stuff that they want to fix. And so that is, I think, the thing that seems like it's in its infancy. This could be a battle that takes place over the course of years. The article is The SEC Targets Private Capital. I just want to read the intro. This was written by Hal Scott and John Gulliver. Scott is an emeritus professor at Harvard Law School, director on the Committee on Capital Markets Regulation. Mr. Gulliver is the committee's research director. These are not disinterested parties, obviously, but let's be that as it may. The Securities and Exchange Commission has finalized rules that will overhaul how the $27 trillion private fund industry, including private equity, hedge funds, and venture capital funds, deals with investors. Last week, 6 trade groups sued the SEC, seeking to block the regulations. Private funds have been largely off limits for the SEC because only high net worth individuals and large institutions can invest. These sophisticated investors can protect themselves. The new rule will upend that 90-year status quo, and it's only the beginning of the Commission's attack on private markets. What are your thoughts?
I thought that some of the arguments made in this article were cockamamie.
Okay.
But one of the things that I think that they're right about is allegedly the powers that be, the regulators, want to do away with different fee structures for different pools of money. But there's different share classes in mutual funds. I don't see that as a big issue. If you're coming with a larger pool of money, yeah, you should get preferential pricing. I don't think it's.
This is the op-ed. The new SEC rule will require that certain fee arrangements be, quote, fair and equitable, and ban private funds from offering their largest investors the opportunity to cash in early.
But I think that is fair and equitable. If you come to the table with $150 million, that's called pricing power. Shouldn't you have a better?
Somebody said not cockamamie, balderdash.
That's a good one.
This is who's been, by the way, breaking our balls the entire 20 minutes now. He said I look like a giant Pepto-Bismol. Thank you.
That's good.
Thanks so much for that. Why don't you go on Dan Nathan's live stream and break his balls? All right. Can I say one thing?
Wait, hang on. What do you think about what I'm saying about fee arrangements?
I think you are falling into the trap of believing this argument, but this isn't really the argument. The SEC is not saying larger firms shouldn't get lower fees.
Okay.
That's what this guy is twisting what they're saying. But they haven't.
By the way, they haven't published anything yet. They're talking about. Okay.
Yeah, but a lot of stuff goes on in the background before it happens. I think what the regulators don't like, and I totally understand it, they don't like where 20 different LPs are invested in a hedge fund and 3 of them are paying less than the others, and it's not strictly based on how big they are. It has more to do with like, oh, I'm taking care of you on this because you're taking care of me on something else. They don't like preferential treatment that's not codified. You absolutely can give price breaks. There's the whole economy depends on price breaks. I was about to say,
isn't that how the world works? Like,
yes. But again, this is rich people making deals with other rich people, right. So the regulators have not been in the middle of this. But now, again, you're inviting retail in. Well, be careful what you wish for, because this is what happens. Let me do one more part of this.
I do like the transparency part. Let's talk about that.
The final rule will establish quarterly disclosure requirements for fees and performance, annual audit requirement, and which will second-guess the valuation of fund investments. The guy's complaining these compliance costs will be borne by all investors. I kind of agree with that.
Probably true.
Yeah. Then he's saying the SEC's rationale for its new rule is that private fund markets are uncompetitive. That's simply wrong. Fees are going down, and the largest funds like Citadel and Blackstone hold small market shares. The 5 biggest hedge funds constitute less than 5% of total assets.
That's erroneous. That's a red herring. That doesn't even matter. Here's what matters.
Matter?
Not to me. I don't think it
Wait,
does.
last one. Performance net of fees has been strong. Private equity funds
Since
have returned
1989?
12%
Give me
a
a
year
fucking
since
break.
1989.
Give me a break.
Compared with 8% for the S&P.
Yeah, give me a break. That was not that's balderdash, malarkey, cockamamie nonsense. Wait, how about this? If they're going to go after private funds or private securities, whatever, they should go after a lot of the things that aren't marked that we know are bullshit. Real estate, for example. Real estate, private companies that are basically public companies in sheep's clothes, like that are not being marked down, even though their competitors in the public markets are down 90%, and they're still charging fees on the upmarked values. That's nonsense.
Glad you brought that up. One of the conspiracy theories being floated here is that there are only half as many publicly traded companies today as there were in the 1990s because the regulatory costs of being public are so high.
Partially true.
So the SEC, but a lot of the missing companies are penny stocks.
Exactly.
Which we've talked about. The SEC sees its domain shrinking, and this is part of a land grab so that they have more stuff to oversee. Here, this is a quote. The SEC realizes that public markets are shrinking and private markets are growing. To protect public markets from shrinking further, it has scheduled in its fall regulatory agenda a full frontal attack on private markets.
I'm sorry, I just don't buy that. That's hyperbolic.
Here's a good one. Do you know what look-through means?
Yes.
Look-through would be disastrous.
Disastrous.
A broker who holds shares in a private company on behalf of clients or a fund that invests in a private company counts only as one shareholder in the company. The SEC intends to look through brokers and funds so that each client or investor would count as a shareholder.
But what's the rationale for that?
I'll finish. This would mean many private companies would exceed the maximum of 2,000 shareholders for a private company and have to register as a public company. The SEC intends to require all private companies to make public filings on their financial statements for the first time.
That's not going to pass.
The idea is to almost force these companies to come public because it's too expensive to report on all of these shareholders if there's going to be a look through.
Well, it's not just
like an omnibus.
It's not even just too expensive. If 2,000 is the limit, and now you bust open all of the separate vehicles that could have 50 people inside of them, then you're over the limit.
Then you're over the limit. Then you're de facto. You're basically a public company that hasn't done the right thing.
To me, that seems like a big stretch. There's gonna be a lot of money spent.
You know how expensive that's going to be for compliance. If private companies have to break out below sub-fund level how many LPs in each fund and who they are.
So I'm obviously for investor protection. There's a lot of things that definitely need to get cleaned up, but this is probably this has the potential to have negative impacts that the regulators aren't thinking about, such as these costs being eventually passed through. They're going to get it. They're going to get around this.
You know who's going to make a lot of money?
Jay Powell. Who?
Lawyers.
Right. Yeah.
So much money. Either way. First they'll get paid for fighting it, and then when it finally eventually happens,
and lobbyists
they'll get paid for.
I guess lobbyists are the lawyers. Yeah, I agree. This is going to take a while to play out. All right, let's talk about two topics in one. We're going to talk about the mixed performance going on in retail, but before we do, there's mixed performance going on all over the place, and I love it. There was a lot of complaints over the years that QE was distorting price discovery and lump that in with index funds, and that there was just this one trade. It was risk on, it was risk off. It was this sector going up and every stock inside of it. That is no longer the case. So I was inspired to create some charts with the help of Nick Majuli from this great chart from Goldman, which I think we actually shared a couple of months back. It shows the average stock correlation, the average sector correlation going down since, I guess, the last year and a half or so. All right, so Nick Majuli recreated this chart. I had him go back to 2010. The average stock correlation with the S&P 500 over a rolling 3-month period has fallen dramatically. Now, this ebbs and it flows, but for 2023, the average stock has a very low correlation with the S&P 500. Of course, the irony in all this, Josh, is that still active managers will probably fail to beat the benchmark. Not probably, will, just given how top-heavy the returns are. And then I had Nick Majuli break it down by sector. So how much dispersion is there within sectors? And the dots represent the cap size. And not terribly surprising, the three sectors that have the highest correlation or the least amount of dispersion is energy, because obviously crude oil is, or just oil in general, energy is a huge input into energy companies, stock price, real estate, and then utilities.
So look at technology. I mean, we know what that dot is. We know that's NVIDIA. The communication service, that giant, that 150% gainer, that's Meta, right?
And what's the 50? Is that Google?
Alphabet or Netflix. So it's exactly what I would have guessed. Like, if chart off, if you would have said to me which sector has the least dispersion between its components, I would have said energy.
Yeah.
These stocks all move as one block. It's a commodity trade.
Yes.
Were you surprised by any of these?
No.
I really wasn't.
I really
very
wasn't.
Intuitive.
Yeah.
Can we put up the chart before the last one? I like both, but I want to make a point here. If you would have asked Nick, do like a shaded pink or green area where there was QE, you would actually see that those arguments held a lot of merit. Look at 2012. You had average stock correlation with the S&P 500 in 2012 was almost 1.0. It's fucking crazy. Look at and then look at 2020.
Josh,
during the height of the crisis.
Yeah.
This is both periods of time with a ton of stimulus.
Well, I think 2020 was when every stock fell together. But in the early aughts, do you remember when the risk on, risk off ETFs came out? I actually think it was Gartman. Do you remember those?
Yeah.
But seriously.
Yeah.
And I think it was the early 2010s, because a lot of things didn't really move together. They really did.
Do they still risk?
No. They shut down pretty quickly.
God. I mean, why? Like, if you were buying a risk on ETF, like, why wouldn't you just buy double S&P? Why would you? Because
ARK didn't exist. But no, point taken.
I mean,
so back to retail. We were talking 2 weeks ago, a couple weeks ago. By the way, housekeeping. We're not going to be. There's no. What are your thoughts next week? We're going to be in California.
All right. We can do that at the end. Where are you going?
Just saying.
Okay.
So we were talking about shrinkage.
Maybe you are.
Who was talking about it? Dick's was talking about shrinkage.
Relax.
Walmart.
Take it easy.
Walmart was talking about it. Target CEO was talking about it. And you made the case, like, at some point they're going to start like begging the government to get involved. So Alex Morris tweeted, this is from Five Below, which stock was doing pretty well up until recently. Here's their comment on shrinkage. We view this as an external societal issue. It will require involvement from government and local leaders to fully resolve it. We've also noticed that traditional measures for mitigation around asset protection are not as effective as they've been previously.
Dude, the pendulum has swung too far.
Yeah.
In the big cities in this country, the politicians are smoking crack. They're all going to lose. It's going to come swinging back so hard the other way. Well, there's two choices. Either it gets worse for a really long time, in which case there's a complete and total breakdown of society, or new district attorneys, new attorneys general, new mayors, new police chiefs.
We need Harvey Dent to get in there and do something.
No, but people, listen, I understand that there's poverty and there's underlying issues, but you're only going to make these places worse to live in, not better for everyone, if there's no rule of law. So I think that the pendulum's going to swing back the other way. And I think that on a local level, you're going to see a lot of Democratic politicians be forced to defend this bullshit. And I don't know what words you could use to defend this. Like, poor people don't want this to be okay either. Nobody wants this. There is no demographic that's like, oh no, yeah, this is good. Maybe there's like 9 people from Brooklyn on Twitter, but there's no voting bloc that wants to see more of these videos on social media.
There's no reason for Brooklyn to catch trap now. Let's get back to the matter at hand. So,
show me these stocks. They look like
retail
trash.
stocks. So you could add Five Below in here because that's in a 30%
Disgusting.
drawdown. So these stocks that are getting smoked: Foot Locker, Dollar General, Dollar Tree, Target, and Dick's. And you would think like, oh, these are just companies with the same demographic, dollar store shoppers. Not. Well, I guess not entirely false, but not entirely true either. Because the next chart, you've got, and this is as of last week, so whatever. Home Depot, 52-week high. Lulu, 52-week high. Walmart, 52-week high or thereabouts.
Are there no flash? I'm not as online as other people. I haven't seen like a flash mob hit a Home Depot. It seems like it's department stores and it's like clothes. Like
Yeah, what are you going to
clothing,
get at Home Depot?
Because it's
toilet,
stuff that you
toilet
want to.
plunger?
Because it's either really cheap stuff where people are just desperate. I guess that's Five Below, or it's like Fendi bags from Nordstrom or whatever that are then going to be resold. Like if you steal handbags, you can sell them for thousands of dollars. It's like not a joke.
Oh, Nordstrom was robbed.
No, I know. I'm saying I haven't yet seen people taking like hammers and nails from Home Depot. Is my
Speaking
point.
of bad stocks, Nordstrom is such a piece of garbage. But anyway, it's not just luxury versus not, because LVMH, for example, is in a 20% drawdown.
Yeah, I have like no interest in that whole sector. I don't own any retail stocks. I don't understand the appeal. I was debating somebody on TV last week, and they were talking about like what stock were they talking about? Some piece of shit. And I was just like, I own a business that like is growing 40% and has 20% margins. Why would I take the money I earn from that business and hand it to a company that's like 3% margins and 4% year over year growth? Like, on what planet would an investor allocate their own capital that way? So I really just don't understand.
When you put it that way.
Right. So,
but anyway, my point is, it's nice to be in a world where like it's not everything going up or down together. Target is not Walmart. Costco is not.
I totally agree.
Whatever. Home Depot is not Lowe's. They're different businesses.
That's right. I totally agree. All right, let's talk about this ERC bubble. I get 1,000 emails a week. People trying to, I guess, get me to be a lead that they can then resell to this company, Bottom Line Concepts, which apparently has thousands of feeders who are sending them qualified business owners as leads, and then they are offering consulting services where they're going to tell me how much the government owes me based on the earned retention. Is that what it is?
Based on how much percentage of your employees that you kept employed through, I think 2021 was the deadline.
All right, so let's do this. There's a Wall Street Journal article over the weekend. Not exactly a bombshell if you're a small business owner, because you have been getting inundated with people calling you, LinkedIn DMs, emails.
And they're on podcasts now. They're on podcasts. They're sponsored podcasts. Yeah.
So this guy is Josh Fox, and I don't know him, and I've never spoken to him, and I don't have anything personal against him, but he seems to be the kingpin of ERC, meaning most of the roads lead back to him. A lot of the people in this Wall Street Journal article are funneling potential clients to his firm, which is called Bottom Line Concepts. He's been around for a long time, but it looks like he really put his foot on the gas pedal after the ERC credit from the pandemic. So basically, his firm has helped clients pursue more than $6 billion in ERC tax refunds, and his company could receive more than $1 billion in fees based on his pricing structure for the work that he does. So just to give you an idea of what the ERC is very quickly, it was created in 2020 to reward businesses and nonprofits for keeping employees on payrolls during the pandemic. 3 years later, it has turned into a headache for the IRS and a bonanza for firms such as Bottom Line that help clients calculate and claim the tax credit. The IRS paid more than $150 billion in ERC refunds through early March, and the money is still flowing. Total payments through July could be $220 billion, with another $120 billion in the pipeline. You're talking about almost $500 billion total, according to that estimate. So all of these people who own businesses and have employees, they're getting hit by salespeople who are like, we can help you figure out how much you're owed and do the paperwork for you. And listen, if it's legal, I don't necessarily have a problem with it. I asked Bill Sweet, our CFO, over the weekend, like, how could this go wrong? So he's basically saying this is like a mill. Anytime you hear the word mill, I remember all the mortgage refinancing mills and all that. Anytime you hear that word, it means shit is sloppy, corners are being cut, and a lot of people are shoving as much as they can into the channel while the getting is good.
Because there's like a whole checklist of things that you need to prove happened in order to be eligible for this.
Yeah.
Right? Like your business needed to suffer as a result. You need to keep all your employees. I don't know all the details, but it's not for everyone.
Well, what's happening is a lot of the people who are pitching this are not the most scrupulous people because it's a gold rush. Mm-hmm. And think about how alluring this is. Like, there are a million things you could sell in this world. You could sell cars. You could sell insurance.
Free money.
Right? Selling free money.
It's good.
Like telling people like you're already owed this money. Like I'm not like offering you something that's not coming to you. You just don't know how to get it.
Yeah, it's your money.
Right. That is all right. So first of all, this whole shit should have been shut down. This should have been concurrent with the pandemic, not 3 years later. But that's a whole other story. The part of this that's scary is the gold rush aspect, and a lot of people just saying whatever they have to say to close a sale. My guess is that in the fullness of time, we'll see that a lot of small business owners got tricked into saying things that they wouldn't have otherwise said because they were told to by a salesperson just to get themselves through. No different than the ninja loans of 2005, 2006. This could be something of that magnitude, given the amount of ERC credit filings there are and how much in a rush everyone seems to be. We asked Bill, like, how could this go wrong? He said it's that many businesses that apply do not qualify under IRS criteria. The promise of quick, easy money leads to a lot of hand-waving, and less than ethical salesmen are lying to tell businesses they qualify when they don't. He turned up this example of a tax firm in Teaneck, New Jersey. They filed $124 million worth of aggregate refunds. Quote, he allegedly told some clients that the government was giving out pandemic-related relief money and that they were eligible because they had a business. He told other clients that the money was a grant. So you definitely have salespeople out there bullshitting, like guys that own a diner and getting them millions of dollars that's not supposed to be coming to them. And maybe the IRS isn't catching this in real time, but it will be caught eventually. That's how it seems like it could go to me. And I bet you Long Island where we live is a frenzy.
Yeah, for sure.
It's definitely a hot spot. Like South Florida, Long Island, these are definitely the places where you're seeing the most bullshit. Staten Island, right?
Guilty as charged, always. All right, let's go to let's talk about the recession.
Okay.
Calls or lack thereof. All right, so Goldman. Actually, before we get to Goldman, chart from FactSet showing the number of S&P 500 companies citing a recession on an earnings call. And listen, this is straight from the horse's mouth, right? Companies were rightly worried about a recession that hasn't transpired yet. Of course it could, hasn't yet.
It's coming.
Well, it might be. But be that as it may, it hasn't. And so therefore, the longer it goes, companies are talking less about it. So maybe they'll be blindsided. Maybe we get maybe we see the lag.
So this is this quarter's conference calls. The number of S&P companies saying the word recession.
Yeah. So it peaked at 238. Again, this is the number of S&P 500 companies. So basically half. Then it went down to 184, down to 147, 113, and now 62. So,
is there a baseline like for this? That's
just
normal.
Chart back on. So just eyeballing this. If it looks like, I don't know, the average was 35 to 40, give or take. So, all right. So Goldman, to their credit, this is Jan Hatzius' work, has been well below consensus. It's kind of nuts, actually, that the Bloomberg consensus has not budged since, I don't know, what is that, December 22? So what we're looking at is 60% of economists that are polled by Bloomberg have expected a recession.
And it's been that way all year.
I kind of wonder if this is the case of, I don't know if this is, I know it's not career risk. It's just people don't change their minds once their opinions are out in the public. But the data has changed dramatically. And there is good reason to suggest that maybe recession isn't coming, at least certainly not to the tune of 60% of people that are asked. So Goldman just lowered their forecast down to 15% on continued positive labor market and inflation news. And I read the report this morning, and I want to pick out something that stood out to me. They said, we still strongly disagree with the notion that a growing drag from the long and variable lags of monetary policy will push the economy toward recession. In fact, we think that the drag from monetary policy tightening will continue to diminish before vanishing entirely by early 2024. That's interesting. I feel like that's a contrarian call. Most people that I read are still saying that it takes a while for the full effects of tightening to be felt. Matter of fact, Jay Powell keeps saying that, right? And Goldman's saying, well, actually, we don't agree with that.
I don't even want to hear the word recession until unemployment hits 4%. Don't even like that's my new answer. Like, okay, sure, maybe, but shut up until there's an uptick in people losing their jobs. Because until then, what are we talking about? Are you crazy? You cannot have a recession where everyone is working. You literally can't. Like, you actually cannot. You could have GDP contract. Sure. You can have retail sales suck for a couple of quarters. You cannot have a recession if more people than ever are participating in the labor force and actively working in jobs. I'm sorry. So now you want to say, well, Josh, unemployment is a lagging indicator. Okay, I'm happy to lag. Because what's the alternative? To predict and then miss a market like what we've had this year? I'll take the lag. Give me the lag. What are your thoughts?
Yeah, you say that now, but by the time, the lag can be pretty punishing, right? Stock market fall 30% before you know you're in a recession. But
So
the point
I'm
taken.
so glad you said that. The stock market fell 30% last year before we knew we were in a recession.
Right.
So I'm going to have to deal with that reality anyway. So for those predicting the economy and predicting recessions, listen, all respect. Can you at least wait for net jobs declining in some way, shape, or form? And maybe it'll happen. Maybe you'll get lucky and you'll get it in the fourth quarter. It's just until it happens, I don't even know why this is something that we're talking about anymore. So that's my take on that.
Good take. All right, I'm going to make the case. I'm going to make the case for energy stocks, and I do own energy stocks. I bought IEO, which
I'm in that.
The oil and gas exploration and production ETF. I bought it, I don't know, maybe 2 weeks ago or so.
It's breaking out technically.
This is very simple. I don't know anything about macro or oil or Saudis or Russians or reserves. I don't know anything about that. But what I do know is that energy stocks are working right now, and momentum is a real thing that I believe in. So, all right, chart on, please. These are the 11 sectors, and energy is the best performing sector for the last 3 months and for the last months. And I respect, I respect trend. I do. Next chart, please. You're looking at energy stocks divided by the S&P 500 to show relative strength. So not only is it working, but it's working even relative to the S&P. So on the top pane is XLE, which is the whole shebang bang. I think the biggest holdings there are Exxon and Chevron and probably Conoco, and then going down the list. The next one is OIH, and these were names that were completely left for dead. Schlumberger, Transocean. These names, I don't know if there was an 80% drawdown here.
OIH is like the picks and shovel companies, like the companies doing geological surveys.
Baker Hughes is another one in there.
Yeah.
So these names were just wrecked. And then on the bottom is one that I own. This is IEO. This is Conoco Phillips, EOG, Marathon, names like that. And they're working.
I'm with you on this trade. I think it's where the puck is going next. Crude hit 87 today. That's the highest level, I think, since November or something like that. Anyway, oil prices had a tough first half. Oil stocks got hammered along with them. All of that is going away, all of that weakness. And August was a really good month for this space. Most of the market pulled back. These stocks, I think, bottomed in June or July and actually had a good last month.
Yeah, so towards the second half of August, there was something interesting where there was like 6 out of 7 days where they tried to sell these names and it closed at the highs of the day. And when you see just that sort of like resistance to selling, which sounds like an oxymoron, but when you see so much buying intraday where they're trying to sell it down after a big run and it can't even close near the lows on one day, that's bullish. And then here we are a couple days later, it's breaking out. So we'll say it's been working. If
you look at the IEO, and I use Y charts to X-ray the holdings, you'll see that the forecasted dividend for the IEO next year could be 6% and change. And based on forecasted earnings, this portfolio trades sub 10 times earnings. So if you're one of these people that is trailing the market and you don't know what to do and you don't want to buy NVIDIA, I feel you. The energy sector has single-digit PEs, high dividends, companies with growing cash flows, good governance. It's kind of like a great place to be. You could be domestically focused like the IEO names. You could be global like the XLE names. And, I think this is an area where you're not paying up because you missed out. These stocks have been in the penalty box for 8 or 9 months now. So I like the call. Let's do the mystery chart. Are you ready to win?
I'm ready to win.
Okay.
Oh, cool. Looks like Josh just left us. That's how bad his charts are. He just decides, you know what? I'm leaving. I'm out of here. Hey, Duncan.
Hey, I think we'll wait on him to join back here.
No, why don't you?
A second.
No,
That was my fault.
I was gonna have Duncan deliver it if you.
No, let's not do that.
My bad. All right.
Let's rock
Duncan,
and
I
roll.
got it from here. Okay. I was trying to pull up the chart, and that's what happened. Okay. John, if you please. So somebody had a birthday over the weekend, and we're going to celebrate with a mystery chart that is highly guessable. I am showing you the market cap of the company, not the stock price, which is $786.92 billion. And that's been growing at a 12% CAGR since 1996, which is highly impressive. And then I'm showing you book value, which is what this person whose company this is frequently has pointed to as his measure of success to shareholders. $539 billion, growing at a 15% CAGR since 1990. Michael, would you like to guess today's chart for the win?
I don't know. It could be anyone. Do you think this gets to $1 trillion while he's still alive? I sure hope it does. But what do you think?
Yes, I do.
All right.
I mean, I don't know. He could expire. How old? You know how old he turned over the weekend?
93.
I mean, that's
So
impressive.
happy
too.
birthday, Warren Buffett. And speaking of Buffett's, rest in peace to Jimmy Buffett.
True. Not like a huge Jimmy Buffett fan, but he's got some great songs.
No, but when you're on the boat, you know, a little yacht rock.
Yeah.
Absolutely.
I feel you. We have one more image to show. Where is it? Oh, this is price. This is market cap, and then this is book value calculated quarterly. You know, this is one of those things where you look at these three charts and they line up exactly as they should. There's no trickery. There's no, but the Fed. There's nothing. This is just a company that has, and by the way, Buffett doesn't talk about book value anymore because of the way the accounting works. He actually thinks it doesn't accurately reflect the success of the company, even though it continues to grow. He's been pushing people away from that metric. We have a picture of Warren celebrating. This is Warren Buffett with Jennifer
J-Lo?
Lopez. This is not this year's birthday. This is 2017, but I couldn't resist. Warren has lived quite a life, and at 93 years old, his stock made a new all-time price high, right alongside right alongside his 93rd birthday. That's pretty gangster.
Love to see
like
it.
you have to now. It's not a new all-time high in market cap yet because they have done buybacks, so there are less shares than there were a couple of years ago.
Did you watch that video that I sent to you and Ben last night of him and Munger?
No,
It was
you slacked it.
He just makes such basic points so eloquently. He was talking about like, well, how do you think about valuation and multiples? And he's like, listen, you're not buying a company for the PE today. Like, I'm interested in businesses that are going to substantially grow their earnings in 5 years and 10 years. So I might have paid 13 times for Coca-Cola, but based on where it is today, I paid 2 times.
Yeah, dude, he is the goatiest goat who ever goated, and that's the final word on that. Hey, everybody, thanks so much for joining us live for an all-new What Are Your Thoughts? We appreciate it. Thanks so much for listening. Over on the audio podcast version, if you joined us late or you prefer to listen, the entirety of What Are Your Thoughts, plus a brand new conversation with our friend Aaron Dillon on the state of the IPO market and all of the deals coming out this September and October. You'll learn a lot if you go ahead and listen. Thanks so much, Duncan, John, Sean, Rob, Nicole. We appreciate it.
What about next Tuesday?
What's next Tuesday? Oh, next Tuesday we're at Future Proof. No new show, but stay tuned. Tomorrow, all new Animal Spirits. And at the end of the week, Michael and I are back with an all-new Compound and Friends with one of the fan favorite guests
Just
that you know and love.
Just reveal.
We never reveal. Have a nice night.